Hello everyone, Justin with Deep Dive Stocks here, and today we're going to be looking at gamma squeezes. We have three main goals today when looking at gamma squeezes. The first is to understand gamma squeezes better. The second is to understand the effects of gamma squeezes on individual equities. And the third is to understand the effects of gamma squeezes on the market at large. So let's go ahead and get started. Let's start with our first goal of understanding gamma squeezes better. Gamma squeezes can be quite difficult to understand and analyze because they are both an event and an occurring, evolving event in and of themselves. So for this section, we're going to try to answer two main questions about gamma squeezes. One, what are gamma squeezes? And two, what are the conditions that are conducive to the formation of gamma squeezes? Gamma squeezes can be quite complex, but one of the ways that we can think about gamma squeezes is as an infection that presents with various symptoms. Much like how a runny nose and a sore throat can be from one singular cause, like the flu or the cold, gamma squeezes can cause a variety of different states or symptoms to appear on a stock once the gamma squeeze has started. But on stocks, it isn't the flu or the cold that is causing all of these symptoms, but rather something called persistent ipsidirectional hedging. This is when options dealers have to hedge in the same direction as the movement of the underlying. So if the price increases, the options dealers have to purchase shares. And if the price falls, the options dealers have to sell shares. And they're doing so in a persistent state. That means they're doing it in a state or a way that is more than what they normally would have to do. Now, this distinction may seem trivial, but it is important to note that there are times when you can have a stock that has ipsidirectional hedging, but it isn't persistent, and so the stock typically won't devolve or evolve, depending on, your position, into what we classically consider to be a gamma squeeze. Now, there are a variety of reasons why ipsidirectional hedging can occur, but most commonly it is because of the shorts. And by that I mean dealer short calls and dealer short puts. Dealer short calls are calls that the retail market has purchased, and dealer short puts are also puts that the retail market has purchased. Both of these types of options can cause what is commonly referred to as a gamma ramp. That short gamma, because the options dealers are short the calls and short the puts, causes that ipsidirectional hedging to occur in both directions, depending on if it is the calls or the puts that are really providing the gamma ramp. When there is an overabundance of these shorts, that is the prime time for a potential gamma squeeze to develop. But those options aren't the only influences that we see during the evolution of a gamma squeeze. While the shorts, or the dealer short calls and dealer short puts, are likely to provide that initial scratchy throat on an equity, there really is a constellation of events that have to occur in order for the progression and maintenance of a gamma squeeze. For instance, one of the main changes that we find is that during the initial stages of a gamma squeeze, the dealer short puts start skyrocketing. Now, this isn't too unsurprising, as we'll see below, because as a gamma squeeze develops, the price typically starts to fall. What does the retail market do when a stock's price starts to fall? They start purchasing puts. As they purchase puts, the dealer becomes short puts, and they both have to immediately sell shares to the market in order to hedge those positions as they open, but the uptake of those dealer short puts also extends that gamma ramp further down. This helps keep sliding the equity down, and as the equity's price begins to fall, more puts are opened up, and we start seeing an increase in the organic bid. So not only are options dealers now selling into a declining price, but because the price has been declining, which is very common in the first few days of a gamma squeeze, we start seeing that the organic ask, or retail investors looking to sell their shares, starts to increase as well. This combination of events is the prime fertile soil for a substantial move that is most attributed to the gamma squeeze. So we see that the conditions for a gamma squeeze require both kind of this initial state and a development of the persistence, both in terms of the options dealers hedging and in terms of the organic ask that starts to enter into the equity as the gamma squeeze matures. So now that we have a better understanding of gamma squeezes and how they might develop, what happens to an individual equity when a gamma squeeze does develop? Let's take a look. The main question we're going to answer in this section is what happens to a stock once a gamma squeeze develops? Of course, the most obvious question is what does the stock's price do once a gamma squeeze develops? And if we look at over 5,000 gamma squeezes and look at the change in the price from the start to the end of the gamma squeeze, we see that the average movement in an equity after a gamma squeeze has started is negative 0.48% prior to recovery. That means on average, the movement of every gamma squeeze that starts is going to be about negative 5%. That can be pretty substantial. We can get a glimpse of this if we look at a few price charts and we color the price based off of if it is in a gamma squeeze or if the stock is not in a gamma squeeze. Here we see Tesla. Red indicates when Tesla was in a gamma squeeze and dark blue indicates when Tesla is not in a gamma squeeze. And we see that the data is coming to life in this price chart very nicely. Whenever a gamma squeeze starts, when that price turns red, we see that there is almost an immediate and pretty substantial downside in the near future. We see a similar story here with SPY, a very similar story here with GME, and the exact same story here with BABA. And these graphs do a really nice job of showing just how drastic the change in a price can be after a gamma squeeze develops. Not only is the change in price predominantly on the downside, but it can be pretty explosive in those first few days with an overall average move of about negative 5% prior to recovery. Another piece of information that we can peek from these graphs is that the gamma squeezes don't typically last that long. In fact, looking at the data, we see that the average gamma squeeze only lasts about 7 to 10 trading days. That means that once a gamma squeeze starts, it can have pretty profound impacts on the price over a relatively short period of time. So they can be pretty substantial. Moving from the individual equity to the market at large, we see that gamma squeezes have just as much of a substantial impact on the market at large as they do individual equities. Let's take a look. First, let's look at the number of gamma squeezes in the market every day. Here, we see that there are particular times when the number of gamma squeezes are quite numerous. Over 3,000 gamma squeezes a day, and this has occurred at least 3 times in the past year. In the past year, the average number of gamma squeezes per day is a staggering 2,000. This is substantially higher than in historical records where the average is closer to 500 to 600 gamma squeezes per day. We'll also notice on this graph that there are peaks and valleys. It almost seems like gamma squeezes grow and then they wane down and then they grow back up again. Do these changes in gamma squeezes have any effect or forecasting ability on the change in the price of the market as a whole? And here, for the market as a whole, we're just going to use SPY as a proxy. To answer this question, let's quickly look at a graph of the number of gamma squeezes in the market compared to the change in SPY's price, or just SPY's price graph, to see if we can't eyeball some correlations. And here, I think it's pretty evident. As the number of gamma squeezes increases, the market-wide instability increases, and downturns in the market are likely. This means that as the number of gamma squeezes increases, the likelihood that the market will experience downside increases, and this downside is usually what occurs. And so we see that the peaks in the number of gamma squeezes throughout the market typically occur at the bottoms of market downturns, while the bottoms of the number of gamma squeezes in the market typically occur at the peaks of market run-ups. So it does seem that there is some association with the number of gamma squeezes in the market and the price movement of the market as a whole, as measured by SPY. If we look at the situation slightly differently, and instead of looking at the number of gamma squeezes in the market, we look instead at the rate of change of the number of gamma squeezes in the market, this relationship becomes even more apparent. For instance, let's take the daily change in the number of gamma squeezes and map that to the future change in the price of SPY. We see that here with this graph. As the rate of change in the number of gamma squeezes throughout the market increases, we see that the average daily change over the next 20 days for SPY decreases. Conversely, when the rate of change of the number of gamma squeezes decreases, or in other words, gamma squeezes are being destroyed, we see that SPY experiences an increase or a positive bullish environment. So there does seem to be an association with the rate of change in the number of gamma squeezes throughout the market and the future performance of SPY itself. So measuring the number of gamma squeezes and the rate of change in the number of gamma squeezes throughout the market can have pretty impactful insights for future price action on SPY and throughout the market. Here we reviewed several aspects of gamma squeezes. The first is we learned what a gamma squeeze is. Then we briefly looked at the development and the maintenance of a gamma squeeze. We followed that up with the effects that a gamma squeeze can have on an individual equity. And then lastly, we looked at how gamma squeezes can affect the market at large and how they can be used to forecast market movements. We saw that gamma squeezes can be defined as a period of persistent ipsidirectional dealer hedging. That means that every time the price of the equity increases, the options dealer has to purchase shares, and when the equity's price decreases, the options dealer has to sell shares. We saw that a common situation is where this negative gamma ramp provided by the shorts provokes a little bit of downside, but this downside then increases the persistence or the amount of hedging that has to be done, typically by the opening of dealers' short puts as the retail market looks to take out puts. This increases the gamma ramp towards the downside while also providing immediate selling pressure from the options dealers. So we see it as a combination of the initial conditions and the new behavior that it comes into the stock to create that persistence. And it is that persistence that causes the stock to lose on average about 5% of its price prior to recovery. And of course, we saw that the effects of gamma squeezes aren't just isolated to the individual equity, but also to the market at large. Most notably, if we keep track of all of the gamma squeezes throughout the market and how they are increasing or decreasing, in other words, we keep track of the rate of change, we notice that there was a strong correlation with the rate of change of the number of gamma squeezes with future market performance. This means that by keeping track of the rate of change in the gamma squeezes, you can have quite the edge and insight into what the market is going to do. And so I hope this video has helped start your journey in understanding gamma squeezes and maybe inspired you a little bit to keep a closer eye on if any of your stocks are in a gamma squeeze. As you saw, it can be pretty important. A 5% decline in price can be pretty substantial. Right? All right, so that's all I have for you guys today. I hope you enjoyed, and I'll see you guys next time. Bye.